What you're highlighting is that in a way, what we're paying for earnings acts like leverage in the stock market. Then we get an outsized return. So what that does is it creates this optimism machine. In a word, what you're buying when you buy it in the stock market is you're buying optimism.
Welcome back to The Long-Term Investor. Today, I'm joined by Felipe Toews. He is the author of The Behavioral Portfolio. Great book, a lot of great takes that I want to dig into. Felipe, this has been on the calendar for a long time, so thanks so much for joining me.
I'm so glad we could put this together.
Well, I'm curious, how did you come up with the title of the book to start?
Our firm is an asset management firm that focuses on hedged equities and adaptive fixed income. And we were sort of forced into the world of behavioral finance because of the abysmal timing of when people would enter and exit our portfolios. So we created a division of our company that we refer to as the Behavioral Investing Institute. I've been doing coaching and talking to advisors about this stuff for 14, 15 years. And, as a part of that, though, we came up with this portfolio that we'll be talking about that we recommend. And the idea of the behavioral portfolio is creating a portfolio that addresses the economic realities of markets, but also addresses the behavioral idiosyncrasies of how investors react. And so it's a portfolio designed to address investor behavior.
What's interesting to me, you and I met at Future Proof, I believe, last year. And at the time I was just getting started on my book, and there's a lot of similarities to our belief system, even if though sometimes we might end up in different places, and we'll kind of unpack that as we go along. But the book is intended for financial advisors, or at least it reads that way. And I think you're quick to point out that, hey, advisors have biases too. And you just mentioned people going in and out of your fund. So maybe let's start there. Like, what are some of the biases that you see most prevalent among financial advisors themselves?
Well, I would say two things about that. First is that, we're all vulnerable to biases, right? So to think that because we have a CFP or even other acronyms after our name, that we're better than that, it's not true. But maybe there's something even more important going on, Peter, and that is that unless we have a built-in communications framework that's effective at addressing investor biases, ultimately it doesn't matter if we're not vulnerable to those biases, because we're going to be forced by our investors to make these bad decisions if we want to keep them as clients, right? So there's that whole thing of like, they're very upset, let's wait another 6 months to see if this rectifies. 6 months happens, then you make the bad decision along with the investor. But right, the data shows that I refer in the book to several studies that says, oops, no, these flows are just the same for advisors and advisor-driven clients as they are for retail investors.
You make an interesting point. For advisors, there's some career risk to staying the course and holding steady and not giving in to what potentially a client wants. I know at PlanCorp, all of our investments are managed centrally. So the advisor doesn't have enough control to sort of deviate. And, you're never going to take the human out of human nature, right? And so like, how can you, whether you are managing billions of dollars or managing your own portfolio, how can you at least build a system around the fact that we're always going to be human? And the system that I think a lot of advisors lean on, and look, we're one of those sets of advisors, is a traditional portfolio of stocks and bonds. And I think one of the core focal points of the book is times in which that can be a flawed solution. Start wherever you'd like. Walk me through why this kind of traditional balanced portfolio of stocks and bonds isn't always as great as it seems.
I refer in the book to a conventional balanced portfolio as an historical accident. And I think understanding that is potentially super important to then deciding where you're going to go with it. So bonds were created to fund governments initially, and then later to fund companies. Stocks were created as a way to share ownership of companies. So these things were really created as funding mechanisms. At some point, someone said, why don't we put these two things together? They began to be publicly traded. Jack Bogle got on the scene, late founder of Vanguard, and talked about 60/40 portfolios. And that's basically the history of the evolution of portfolio construction, right? So, but what never happened, Peter, is what never really happened is, well, first of all, we had these limited tools, right? That's all we had. So come to today where we've got options, to help hedge against down markets. We've got all kinds of derivatives, all kinds of different tools and products. And what it has allowed us to do is ask the question, what actually do investors need economically and behaviorally, psychologically from their portfolios? And so that becomes really interesting, Peter, because now you're saying, well, what do they want? Well, they want to not lose their money. I mean, that's number one, probably. They want to have above inflation returns. They want to have some consistency of growth. They want to have returns when the markets are moving higher. And so then it becomes a question of how you build that. But I kind of went ahead a little, Peter, of where we probably will end up. And I'm going to come back to your question about conventional portfolios and balanced portfolios. So you've got this historical accident, and you ask the question, well, how good a product is that? How effective, reliable is a balanced portfolio kind of conventional approach? And are there times when it actually doesn't work? And so if you'd ask, what's the most interesting finding that an advisor comes away with after reading the book? Almost every time I have a conversation, Peter, with someone who's read the book, they say, the first third terrified me. Right? Why? Why did they get terrified? Well, I illustrate a balanced portfolio going through the Great Depression. And it's basically a down market of 13 years. Instead of stocks losing 57% as they did during the Great Financial Crisis, there was a downturn of 86% during the first 2.5 years. Went up for 5 years and down another 5 years. But I show a balanced portfolio with real world characteristics of advisor fees and other things like that over this time period with rebalancing and all the just sort of real world stuff. And that portfolio draws down 72% of balanced portfolio over about 3 years. So, for investors that are on the line, for financial advisors on the line, you ask yourself the question, if 3 years into a project, you had 28% of your portfolio left, how is that navigable? And then you rally for 5 years, you're still down 36% at that peak, and then you have another 5-year downturn, but you end the 13-year period down 68%. It's the advisors that look at that say that is not navigable. And so then it's a question of asking, would that ever happen again? Or do we really need to think about that or prepare for that? My answer is for this, and this is for the financial advisors out there. If you ask the question, what is the main thing that your investors really are looking for from you, is probably first, keep me from running out of money. Don't let me lose everything. And so just like if we're responsible breadwinners, we make sure we have life insurance, even if we're super young and super healthy and we feel like we're basically immortal. The way to approach this, Peter, is to not just assume things like that can't happen, but rather say, look, I still want to invest optimistically, but I want to address contingencies in a way that helps me be more secure. So there are two other examples I use in the book, Peter, because to see the Great Depression, it means looking back more than 50 years. And that's really hard to do. So we're not looking back that far, but we're also not looking geographically very wide, because just in the last 40 years, Japan went through a 28-year bear market where stocks lost like 72% over 28 years. So we're also not looking far away from where we are. There's also a 36-year bond to bear market between 45 and 81 that I don't think we're fully contemplating. So the idea is expand our scope and then address those contingencies. And then bringing that back to what I was talking about, what our core objective should be, it really potentially significantly changes up where we go when we're thinking about portfolio construction. So I know I should be a good guest, Peter, and allow you to ask questions.
Well, no, I think it's great. I mean, there's a couple things as I think about the typical audience. So first of all, if you're watching us on YouTube, if you're watching us on Cheddar, you go to the longterminvestor.com. You'll find really detailed show notes of what Felipe is sharing here. You'll get a link to his book. You're going to get a link to some other resources that I'm about to mention or will mention. But what strikes me as really interesting when I think about we poll the audience, and we know that maybe like a third of them are do-it-yourself investors, a third of them are financial advisors, and a third of them are either clients of Plan Corp or clients of some other financial advisor, roughly. So we're at about a third. The do-it-yourselfers have had a really easy 20 years or so. Post-financial crisis, I guess we're talking about 17 years, and you mentioned Jack Bogle. The Bogleheads and their simple 3-fund portfolio, it's just been easy street. And so what I really appreciate you going through in the first chapter where you walk through the hypothetical investor going through the depression, you walk through multiple downturns, including the financial crisis. And it's not to be a doomsayer here. I think it's just to point out that, hey, if you have multiple decades, and correct me if I'm wrong in your opinion, but like if you have a 30 to 50 year time horizon, yeah, this portfolio can work out for you, but that is really easy to say in advance. Like living through a losing period in the moment can feel like an eternity. The long term feels like an eternity. People think 1 year, 5 year, even 10 years is long term. But statistically speaking, 10 years is not long term. It's not short term either. I'm not being flippant about it. But that strikes me as something as a group who ought to be leaning forward or turning up the volume on the conversation, or people who've just had easy wins with a simple portfolio that's US dominant. The other group are the advisors, where there's been an explosion in new RIAs formation and people who don't have robust investment teams to look into some of the things that we might talk about. Again, the perfect portfolio, there's not a single one out there, it's just the one you can stick with the longest. And so, I mean, you point out why this can be flawed. I think what's relevant about when the book came out, as well as today, is like, hey, it's been easy for most investors. Now valuations are higher. Like, how do you think about the way in which market valuations ought to be impacting not just the portfolio, but financial planning models that do-it-yourself investors are using or advisors are using with their clients?
Yeah, that's a fascinating topic because the way we think about portfolio construction is relatively static, right? We look at goals and objectives, and we look at long-term returns of different asset classes, and a lot of financial planning software is based on that. I will say that there is some financial planning software that does take into account, when doing retirement planning projections, what expected returns are based on valuations. But yeah, there are a couple of things that are relatively good predictors, or at least help predict, to know what returns might be. And so, for example, with stocks, looking at the 10-year average price earnings level is a fairly good indicator of what your returns might be. And so we can bring this to right now and look at that. It's like the CAPE index, which is Shiller's, by the way, one of the greatest minds in all of our industry. He published Irrational Exuberance in 1999. A great read for anyone that's looking for something and understanding of bubbles. So always good to do it before the big downturn. But right now the CAPE index is around 38, which is near record highs. It's the only time it's been higher is in the 1999 when he was writing the book. So that indicates potentially low returns. On average, if you're just looking at the last 50 years, Peter, where we are on price earnings levels right now means that over the next 5 years, we would typically have 0% total gains, not above inflation, but 0% nominal gains. Another thing I showed in the book is that for bonds, if you look at the starting yield, that can be a good indicator for what your total return is going to be in bonds over even very long periods forward. So, if your starting yield is something like 1%, your return expectation over the next 30 years is meaningfully lower than overall average return in bonds. So looking at that is really important. But the question that is sort of a riddle to solve, Peter, is that what do you do about it, right? So if you happen to be in a scenario where, I mean, really a worst case scenario would have been right around 2021, because you did have those very low yields and very high valuations coming into 2022. And so what do you do about it? And that is somewhere I go in the book in terms of like thinking about pragmatic, explicit ways that you can address this in portfolio construction.
Now, this is a slightly different direction than where you're going, but it's relevant. So there, at the beginning of this year, I spent a lot of time, episodes, if you're watching on YouTube, Cheddar, if you're listening to us, the longterminvestor.com is where you can go, and I'll link to these episodes. But episodes 239 through 241, we were talking with experts as well as just kind of looking at solo episodes internally on how we're setting planning expectations. And one of the things I really appreciate, you spent a dedicated chapter, I believe, on saying like, hey, it's important to understand that stock prices are driven by earnings and the prices paid for earnings. And you can go back and easily look at returns and say like, hey, what amount of the return came from cash returned to shareholders in the form of dividends or buybacks? What came from changes in earnings? And what came from changes in the price people are willing to pay for those earnings? And as we sit here recording in April of 2026, we're seeing people not willing to pay as much for $1 of US earnings as they were for the past several years. And so, unless I've already stolen your thunder, maybe expand on what I'm talking a little bit about with the earnings as well as the valuations. And then maybe kind of talk a little bit on how you would propose people take that into account based on where we are today.
What you're highlighting, and maybe you use this word, but what you're highlighting is that in a way, what we're paying for earnings acts like leverage in the stock market. And so if you're starting at 15 times earnings and earnings increase by, let's say, 10%, but the amount we're willing to pay for those earnings also increases by 10%, then we get an outsized return. And so what tends to happen during long-term bull markets is that you meaningfully expand the amount we pay for earnings at the same time that one would assume we're also increasing earnings. So you might even get a 2x experience, right? Where earnings increase 40% over some time period and your stock market increases by 40%, so that is, and so what that does is it creates this optimism machine that changes everything. Now that also affects GDP because you get more spending, and it's just all creating optimism. And it's just as if you had leverage on earnings. And the same thing, though, unfortunately happens in down markets, right? So if your starting place is 22 times earnings, is how much you pay for each dollar of earnings, and then your finishing place is 10 times earnings, even before you consider any loss of earnings in companies that you're investing in, you can have a 50% loss in value of your portfolio. And the words that I use that I think is important to understand for stock market investors is that when people invest in the stock market, I think sometimes they think that there's something really necessarily solid behind it, like bricks and mortar or great management teams, and all that stuff does exist. But really, I'm going to define it, bring it down to one word, Peter. In a word, what you're buying when you buy it in the stock market is you're buying optimism. You're buying optimism because if we're pessimistic about, what do people, mom and pops, brick and mortar businesses, what do they sell? What times of earnings do they sell their companies for? It's about 5 times earnings. But we pay on average 15 times earnings on stock market exchange. And so the difference between that mom and pop level and the stock market is that we assume there's going to be earnings growth. And that's what justifies that 15 times multiple. And then when you get into times like now where we pay 22 or 23 times earnings, that's even more optimistic. So really, without anything else changing, as fast as we can go from optimistic to pessimistic, we can go from a great rich, wealthy person portfolio down to significant deterioration. So that's, put everything else aside. The main thing you're buying is either optimism or pessimism in a portfolio.
Yeah, and I feel like when you see those expanding valuations, you're seeing the optimism just increase. When you see the valuations decreasing or contracting, you're seeing the pessimism increasing. One of the things that strikes me, and I love it when people reference the importance of earnings, because to me, it's all about the earnings and it's all about what people pay for them. So you and I are on board there. I think when you don't understand that, sometimes it doesn't help. It creates confusion around what risk really is. Now, it doesn't help that there are dozens of different definitions of risk in academia, in real life, in finance, in non-finance issues. You unpack this a little bit. I mean, talk to me about accurately defining risk. How should investors be doing it? Why is it so important? What mistakes do they make?
So it used to be that, it's really interesting to answer that question. If you look at what financials advisor's job used to be, it used to just be persuading people that weren't in the stock market to come into the stock market. That was when stocks were not as prevalently invested in across households as they were. But you really didn't necessarily, if you're persuading people to come from CDs into the stock market, want to talk about the big down markets. You'd want to just project optimism in the stock market. And I think part of our industry's problem is that we define risk maybe in a way that is not, I'm going to say, accurate or fully transparent. And so the word that I'm going to focus on here, Peter, is the word volatility. Okay? Volatility means going up and down. And most people don't have a huge problem with up and down. Most people have a huge problem with down, down, down. But volatility suggests, it conveys this thinking of, even if it does go down, it's always going to go up again. It's just moving up and down. And so the word that we need to think about when we think about risk is we need to think about basically just losing money. And the reality that's not fully accepted in the investor or the advisor community is that if you're in stocks or bonds, they can actually lose all their value. I think people understand that more with bonds. Bonds are totally fine and they're always okay right up until they're not. If an issuer is not able to pay interest and then all of a sudden becomes insolvent, that's clear for bonds. So what we need to focus on, first of all, is comprehensively think about risk from a broad economic historical perspective. But then we need to define it based on what are the probabilities of not reaching your goals. And I think you guys focus a lot on goals-based planning in your firm. But what are the chances of not reaching your goals? And then how can we lower the chances that you don't reach your goals or have significant impairment along the way?
Yeah, these definitions are so important. And even as you're talking, I started Googling because I'm thinking, I bet if I Google definition of risk in finance, there'll be a dozen results that come up. And I'm eyeballing it and I see maybe 9 quickly. And the real key here is that there are probably just lots of different shapes of risk. I think you've identified one of the most important, if not the most important. Sometimes when we're going through like retirement planning, we talk about the risk of running out of money. And on the other end of the spectrum is the risk of dying with regret. And so like if you fully eliminate one, you're probably going to put the other one front and center. But there is just general like risk of the wrong set of expectations. When somebody invests in a portfolio and they have the wrong expectations in place from the start, they're not set up for success. And risk from an allocation perspective, which you or an allocator's perspective, sort of what you highlighted, like volatility in the academic sense, has some use to us, but I'm sort of with you. I don't think people are nervous by the volatility. They're nervous about the narrative attached to the volatility and like, will I be okay? And so, I really do think this defining risk is really important. And when you make an investment, you really understand its purpose. I always think of like the reason we invest in the first place. So we're trying to grow our savings faster than the rate of inflation without taking unnecessary risk. Now, here I am using the word risk, trying to say like, well, what are we trying to accomplish? What's unnecessary risk? What is necessary risk? There's a lot of stuff to unpack there, but I only know that we have so much time. So let me jump ahead a few steps. We've talked a lot about some of the issues with planning models and framework and portfolios. You talk in the book about how we can immunize ourselves a little bit from poor decision making. Can you tell me some about that?
Okay, so the first thing is that we've alluded to but not talked about in any explicit way is like thinking about it first from the portfolio perspective, which is to say, it's a little bit like if you get in a car and you want to go somewhere, and instead of it moving forward, it goes backwards, and it just keeps going backwards and backwards. And then, so we send in a behavioral coach to help you feel better about the fact that your car is going backwards, right? It's like, no, first we need to make sure that the car is going forward, right? And so I think that's, I believe one of the big insights in the book, which is that, no, behavioral coaching doesn't start with the, navigating what's going to happen in the markets. It starts with making sure we're, as we talked about earlier, in both investing optimistically and addressing contingencies of either big stock market downturns, big bond market downturns, or stagflation, which means both. So that's number one. But then, so Peter, one of the things about this idea of how you address like decision making and navigating whatever is going to be presented to us in the market is that I don't think that the sort of like what typically happens is an advisor will say, look, we've got a diversified portfolio. One thing will go up and another goes down. We're going to wait it out. That'll be fine. So in surveys that we did with investors over 3 years in the last 10 years, is we found that investors don't really understand how bad markets can get. Only about 25% really grasp that. They don't understand how their portfolios are prepared to address contingencies. And they don't know what the plan of action is in the event of some of these crises. So our insight is that what one needs to do is create proactive communications around the investment challenges that we all know are going to happen. So the one that we've talked about a lot already is big losses. So instead of avoiding talking about how stocks can go down as much as 86%, as they did during the Great Depression, we actually talk about that. Now, that could be a little uncomfortable for someone that's thinking about putting their life savings 60 or 70% into stocks. But you do that, but then the very next step is you talk about explicitly what's happening in the portfolio to address that possibility. And then you talk about what the market typically does when that happens. You give some historical context to that. And then you ask the investor to make a pre-commitment around it. So, and you're going to talk about your pre-commitment as an advisor too. So what you're doing is you're laying out this landscape. I have a great example of way back in 2011 when I was doing a workshop for behavioral finance. There was an advisor there who talked about how during the financial crisis, his investors kept calling in and wondering when they were going to rebalance back into the stock market, right? So they were all on board for what is typically a very difficult contrarian decision to buy into a sharply declining stock market. But that's what I think we need to achieve. So whether you're a do-it-yourselfer or working with an investment advisor, really having a plan for all of these things. And then in the book, Peter, we lay out 6 of what we think are the biggest investment challenges that investors focus. Long periods of low or no returns. I've got one for you, Peter. Bubbles. Think we're bubblicious anywhere right now? Stocks or crypto or anything? And so what you create then is that really a knowledge base and a planning base that is proactive, so that now things happen and you're like, oh, yeah, I know how my portfolio is designed to address this. Yeah, I know what our plan is. And for the advisors that have implemented that tends to be a big change in productivity around some of these biases.
I'm glad you brought that up. I was actually going to close with you. You go into great detail on a number of different behavioral challenges that an investor, as well as advisors who are coaching investors, will face, whether that's significant losses, long periods of low or no returns, underperforming strategies, managers, or assets, not participating in asset bubbles, or inflation and rising interest rates. These are all things. So I'm nearly at the 2-decade mark of my career. And all of those things have happened. All of them. And I think when you start, you learn quickly that losses are normal. But I think of all these, and sticking with something when it isn't working for a decade is really hard. And that kind of fits in that long periods of low or no returns or underperforming strategies. And so I think back to when I started in the summer of 2007, from then till like around 2011, nobody wanted to be invested in US stocks. All they wanted were international stocks. They primarily wanted China. For the past 10 years, nobody's wanted anything to do with international stocks until last year. Similarly, if you were a quantitative value investor for a long period of time, like that underperformed for a long period of time, all within the realm of expected outcomes. But if you weren't prepared for it, if you weren't told about the expected outcomes, you think it's broken. And so much of investing mistakes, I think, comes from a place of regret. And regret is so obvious when it's black and white on a big scoreboard and you can easily see an alternative path, even if you didn't know in advance, like with the information you had at the time you made the choice, maybe it was a good one, but the outcome was bad. So it's a lot of what you're talking about. I love that you bring it up. Is there anything to close us out that you'd like to color in the gaps on from what I'm saying, or just that we haven't touched on in that realm?
I just think that, and this is a message to the advisors out there, is that I just think it's a huge opportunity to think about both what we've talked about from a portfolio perspective, but also from a coaching perspective, to provide real value at a time when we have so many existing and potential challenges to our industry, right? Where 5 years ago, everyone was talking about robo-advisors. That didn't really take off. But now there's the idea of AI-driven advisory business. But whatever it is, like if you think about, like what's the value? What is the value that you're adding beyond just helping investors invest confidently and making some decisions and getting going with things? Like once you're in that portfolio, and in the book, I highlight the fact that Morningstar shows that there's a performance gap of, on average, about 1.7% between what funds earn and what the investors in those same funds earn. That's huge. And so if you can help through doing this, this proactive communications framework and the portfolio, reduce or eliminate that in many cases pays for more than your fees associated with that. But it also brings a lot of potential peace of mind and a smoother glide path for investors who do that. So I just think it's a huge opportunity. And so instead of fearing that or thinking about the labor involved, just deciding, that's something I can really do in my business to improve the value of what I'm offering.
Well, Felipe, I have really enjoyed the conversation. I think I've left a lot of things out there for people to learn more by picking up a copy of your book, which I'll link to in the show notes at thelongterminvestor.com. But if people want to find your work, what's the best way to keep up with what you're doing?
Yeah, so just go to the website, the behavioralportfolio.com. Go there. I run an asset management company that talks about some of the products that help fulfill something I usually talk about, which is ToewsCorp.com. But love to interact with anyone who's interested in doing that. So, yeah.
Everyone watching and listening, be sure to check that out. And Felipe, thanks again for hanging out with me here today. As always, everyone, again, thelongterminvestor.com is where you can go to find all this information. And I look forward to seeing you all again soon.